then and let's shift into to a different sector altogether. We have Karan Tarani, who's the Senior VP at LR Securities, joining us on the phone line right now, or he's joining us right now. Very good morning to you, Karan. Thank you so much for joining us in ET Now. And I wanted to understand your take. You have Zomato that's gone ahead and changed the stock name to Eternal, this in order to distinguish between the app and the company. So under this branch, now they will have Blinkit, they'll have Zomato District as well as Hyperpure. How should one actually look at this move? Should we even read into it too much?
Hi, good morning. I don't think we should read too much into this move because there is no material impact in terms of the financials or the management or the way the company functions in terms of operations. But just 2-3 points to highlight here. I think this move is a very good thing because what was happening is that because Zomato was the mother brand, a lot of spotlight was coming on Zomato. And if you look at the other business segments, Blinkit rather, it actually has a very big potential market and it's actually going to become much bigger as compared to what Zomato food is. So you are not going to overshadow just one single brand, and that is something which is going to help the cause in terms of why the name is changed. It's basically an evolution of an internet conglomerate. It's happened globally as well. If you look at many of the other companies like DoorDash globally, they also have kind of multiple brands under the umbrella branding strategy, which is the AliExpress as well. So I think this is something in line with what global internet conglomerates do. Also, very interesting perspective here is that there is nothing to do for the customer. So there is no negative impact in terms of customer mindset because the app names have not been changed. So Blinkit, Zomato, all these app names will not see any kind of changes. So there's no negative impact for the customer. One more thing this is going to work out for in a very positive manner I see for Zomato is that Eternal can actually expand into new business horizons because Zomato primarily started as a food tech company. So you have Zomato Blinkit, you have Zomato Hyperpure. A lot of confusion was there in the minds of the customer. So having Eternal as a brand and having multiple brands under that also gives you the leverage to kind of expand into new business offerings. I mean, they could get into logistics, they could get into anything else. They already have about 3 to 4 business segments under their umbrella branding right now. So I think this is actually a good strategy, and there's no negative impact of this. It can only play out in a positive manner.
All right. Hi, Karan. This is Shrishti also joining in. But apart from Zomato, the other stock in focus is Trent. Given the numbers and given the disappointment that we have seen in the LFL growth specifically, help us understand that how are you seeing Trent numbers, and also given the valuation discomfort, do you believe that there's more scope for stock correction even from these levels?
So Trent, I think in terms of numbers, they've done a reasonable good performance, 37% growth, revenue growth, YOY basis on a standalone basis is a decent set of number because if you look at the other players in the value retail segment, they are much below 30%. So on a high base, having a higher revenue per square feet or a higher throughput per store studio, they have done well in this kind of an environment and this kind of a quarter. The second thing too is watch out is that margins have also kind of improved on a Q1Q basis, and this clearly goes to show that there is no margin pressure as such despite the increased competitive intensity. So we actually may not see any downward revision as far as margins is concerned. Growth numbers are in the line of 30 to 35% on annualized basis. What we basically foresee is that, despite increased competitive intensity, Zudio will continue to have its moat. Trent may not lose market share in the fast fashion segment. They may not even gain market share. But the only thing is that they will probably grow in line with industry average growth rate of 30-35%. So unless those growth rates are maintained, I think Trent right now has reached a stage in terms of, coming at some compelling valuations. If you look at the FY27 P multiples of Trent, it's at about 70 times forward. So clearly, I think the bottom is largely done. Again, the up move is potentially about more than 40%, but it may not come in the next 1 year, 1.5 years. It will take some time, given the kind of environment we are in right now, given the kind of increased competitive intensity that we are seeing, and also pressure in terms of growth rates. So I think very clearly, if they're able to maintain that growth rate of 30-35%, you will see multiples getting re-rated in a slow and steady manner.